Thank you very much for joining us here at USC. My name is Larry Harris. I am the director of the Center for Investment Studies, Center of the Marshall School of Business, and professor of finance. I hold the Fred V. Keenan Chair in Finance in the Marshall School. It's my pleasure to welcome you to our panel today, the real estate and credit meltdown. And the question, of course, in front of us is how did we get here? And, of course, more importantly, how do we get out of here? Before we start, I want to address a few technical issues. First, I would like to remind you to silence or otherwise turn off your cell phones. Give you a moment to do that. While you do that, I want to welcome everybody who is listening and watching us on webcast. We appreciate that you're able to be with us, and we look forward to sharing our time with you. I'll keep my introduction very short. Yesterday, the stock market dropped 3.5% after dropping far more intraday. Today, you're all aware that the stock market dropped an additional 5.5%. These changes in valuations follow very significant drops that occurred in the weeks before. There are a lot of people who are very scared right now. And so the questions that are in front of us are questions that are extraordinarily important. We have an extraordinary amount of expertise in front of you, and look forward to hearing from all of them. I was scheduled to be your moderator, and I rather selfishly decided to sit on the panel so that I'd have a chance to speak. I hope that you all forgive me for taking that. So it's my pleasure now to introduce my counterpart and co-sponsor of this program, Richard Green, who is the director of the Lusk Center for Real Estate, a center that's shared between the Marshall School of Business and the School of Policy, Planning, and Development. Richard is one of USC's great stories. He just joined us from George Washington University in Washington, D.C. We're extremely pleased to have him join us, and particularly to join us this year at USC, and also to head up the Lusk Center and to be with us tonight.
Well, thank you, Larry. And of course, Larry Harris is one of the reasons I wanted to come to USC. It's a very distinguished community of scholars who are interested in stuff that I'm really interested in, which is a really good reason to come to a university. As Larry said, I am director of the Lusk Center. Let me just throw out one more scary thing to you, because I'm sure you're not scared enough yet. I don't worry that much about the stock market. What I worry about is the fact that people aren't willing to lend money to one another. A great indicator of this, my favorite indicator of this, is something called the TED spread, which is the spread between LIBOR and the 3-month Treasury rate. This is a spread that, going back to the origination of LIBOR in the mid-1980s, typically runs around 50, 60 basis points. This week it touched north of 4% and is now in the high threes somewhere. And what that means is that banks don't trust each other. And what we don't know is, do they not trust each other for good reason, or do they not trust each other just because they're scared? And somewhere between that normal 60 basis point spread and 400 basis point spread is some of each, I think. And I'm hoping to be illuminated a little bit by our panel tonight on how much it is of each. Before I introduce our moderator, let me just also say I am, in fact, new to the Trojan family. When I first heard that phrase when I was interviewing here, I thought, boy, how corny could they be? But this shows me what a real phenomenon it is. As it happens, Jack Knott was in my office about a week ago. He had the idea of pulling together a group of experts to talk about this topic for the broad USC community. Our staff's put it together in less than a week. Jack's going to tell you a little bit about who those people are. And then to see this community turn out on such short notice is a very heartening and very wonderful thing to see. So thank you for giving me, I think, something really wonderful as I start at this institution. So let me introduce our moderator tonight, Jack Knott. He is the Piper Chair and Dean of the School of Planning Policy Development at the University of Southern California. One of the pleasures, again, of going through the interview process and getting this job is getting to know Jack a little bit. What I need to tell you is that Jack is an outstanding, nationally recognized political scientist, which means we've told him he is not allowed to talk about the debate tonight. He has to keep us focused on financial matters. So with that, let me turn it over to Dean Jack Knott.
Thank you, Richard. Thank you very much, Richard. Well, I had the pleasure of having dinner with our panelists, and I was a little nervous about the economy before dinner, but now I'm really nervous. So I have a little bit of indigestion, so if you bear with me on that. First, I'd like to thank the Marshall School of Business for collaborating with our school, SPPD, in this effort, and especially Jim Ellis, the Dean of the Marshall School, who couldn't be here tonight, but gave strong support for this event and for the panel. I also wanted to say that Richard mentioned to me that this could never have happened so fast at George Washington University, so I concur that USC can really pull things together in a way that many other places can't. I'd also like to thank the staff for that reason. We have a remarkable set of people that work at USC, not only in our school, SPPD, but also in the Marshall School. And they deserve to be named because they are the ones that did the bulk of the work in making this come together. So I will start with the Marshall School, and I especially want to thank Mary Jackson for her work. Also, Evie Lazzarino, Leroy Hudson, Jerry Whitfield, Clara Caribbean, and from the Marshall School, and then also from SPPD, Sonia Savulian, Nina Tabian, Marilyn Ellis, and Jennifer Frappia. Please give these people a round of applause. There is one further thank you that is due, and that is the alumni associations of both Marshall and SPPD, and the USC Alumni Association under the director of Scott Morey also provided invaluable support, as well as the USC Communications Office under Susan Heitman. So this really was also a USC effort. The format we're going to use for this evening, we thought we ought to have a dialogue and a conversation rather than 6 lectures. This is the kind of issue, this financial crisis, that really requires interaction, and we hope to get interaction among the panelists, as well as interaction between the panelists and all of you. So what we're going to do is, and we have distributed some of these cards already, and you should have one. We have distributed cards to the audience, and if you have a question about what caused the financial crisis, some feature of it, how we might get out of it, please write it down, and students will come by periodically to collect these cards, and we will sift through those and use those as kind of a guide for the topics that we're going to talk about this evening. We have about 90 minutes, and we have several people that have a tremendous amount of expertise to illuminate us on this topic. So part of my job is going to be to move people along if they get a little long-winded or too much into one subject. So I want to apologize in advance if I interrupt or push people along, because without that we might not cover all the topics that we need to cover. I'm going to start this off while you're thinking about what question you might like to write down and pass forward. with a question for each of the panelists. And before I do that, let me introduce each one of them. And you've met two already. You've met Larry and you've met Richard. Down on the far end is Raphael Bostic. He's professor in the School of Policy Planning and Development and also the director of the master's degree in real estate development. And he's also a former staff economist at the Federal Reserve Board of Governors. Next to Raphael is Brad Hintz. And Brad is from the Sanford Bernstein Company, an equity research analyst covering the securities and asset management industry. And he's the former chief financial officer of Lehman Brothers. For the last 6 years.
Let's hear that one more time.
Yeah, you want to do that again? That was very good. See, that's what we're talking about with the dialogue. We're really getting into this. For the last 6 years, he has been nationally ranked by Institutional Investor magazine and Greenwich Research Associates. Next to him is Bob Rodriguez. He is the CEO of First Pacific Advisors, an investment management firm. And he has been named Best Fund Manager of our time by Money Magazine in 2008. And then next to Bob is Ken Winston. He is the Chief Risk Officer at Western Asset Management and former Managing Director and Firm Risk Officer at former Firm Risk Officer at Morgan Stanley Investment Management Bank. So those are our panelists. They have, as you can see, a wide range of expertise. So maybe we could just give them a round of applause and welcome. So the first question we'd like to start out with while you are thinking of your own questions, and I'm going to start with Raphael Bostic down on the far end and then move in my direction and ask each panelist to address this question. And that question is, what do you see as the chief cause of the current financial crisis? Starting with Professor Bostic.
Well, I want to start by thanking everyone for coming out. It's good to see so many people. And Jack, I was hoping you'd start at the other end of the table with that question. This is actually a really hard question because there are a lot of moving parts. If I had to highlight one cause, I'm going to do this sort of multidimensionally. I would say it's multi-party greed, that we had an environment where there was a lot of money to be made in a very short amount of time, and as risks started changing, and I think you'll hear through the course of the night, it was observable that pools that people were investing in, the strategies people were using, those risks were starting to rise. But even as those risks increased, nobody's behavior changed. And it didn't change because people were still making their money. And I call it multi-party greed because we can't just point to any one party. And this is sort of why I'm sort of cheating on the question. It comes down to households and potential homeowners, people who are buying homes. It comes down to brokers and lenders. Banks played a role. Investors had a role as well. And also the regulators. Each of them had a role in terms of not really recognizing that we were moving closer to a very, very high-risk environment and changing their behavior accordingly.
Thank you. Brad?
Well, I guess I'd greed, since I've been working on Wall Street for 20 years, there are very few people who are doing it for altruism. But I guess the thing that I would point to is securitization. It's a wonderful technology. Securitization allowed us to take credit card receivables, the stuff that you charge on your MasterCard, and turn it into a bond, or take mortgages and turn them into a bond. One of the problems with securitization is it broke the link between the guy who originated a loan, the guy who actually made that loan, and then who was going to hold that loan. So as a result, the quality control in terms of that origination dropped. If I originated more mortgages, I made more money, and I didn't worry about the risk because someone else was going to take the risk on the other's hand. Now, I guess I'd add to that the fact that that the manufacturing process, which is, if you think about it, the prospectuses that are done as part of that securitization process, really talk a lot about the ingredients that go into those products. And so the SEC wasn't exactly acting like the Food and Drug Administration in terms of making sure that they told you that red dye number 5 was in that securitization. And then with that, I guess what I'd say is we trusted the rating agencies. Well, the rating agencies put on their pants one leg at a time, just like you and me. And they are not the most highly paid people, and they are overwhelmed with the volume coming through. And after a while, they slowly moved, approving things that, a little higher, a little higher, a little higher. And then we add to that one credit officers that after a 4-year boom, it's not career enhancing to say no to something if every time you said no, you were proved wrong. So after a while, what has happened is you've slowly moved the goalposts just a little further. And of course, that leads to, I guess I want to kind of leap into Episcopal theology on this and say, these aren't mortal sins. It's like a boatload of venial sins that everybody did that now we're all paying for.
I don't know about theology and all, and sins and whatnot, but I have to say is that if these weren't mortal sins, then I don't know what a mortal sin is in financial. This was an utter, complete breakdown in the U.S. financial system. Straight and simple. It was unsound lending, a total dereliction of responsibility, moral turpitude. You go down the list. We deserve exactly what we're getting. If you want to know who's responsible, look at yourselves. This is about excessive leverage in the U.S. financial system. It was compounded by the U.S. Federal Reserve and Alan Greenspan with an absolutely absurd, totally insane monetary policy that took rates down to a level that was irresponsible. And as a result of that, we had the brokerage industry, the financial services industry, we had the federal government, and we also had the American public. And they all participated in this ungodly party. Nobody wanted to earn a low return, so that allowed Wall Street to manufacture this abomination of product. It allowed people to buy homes that they couldn't afford. It's about a total abject, I am not responsible. The investment community, I'm not responsible. I didn't know what was going on. It's the regulatory authority. I didn't know what was going on. All I can tell you is that my firm, more than 3.5 years ago, we started writing about this. We identified the exact areas, and we did it with a total of 3 people. So when I look around, what was the cause of it? It's excessive leverage and unsound monetary policy and an American public that added more debt in 6 years than in the prior 40 years combined. Leverage is great on the upside. It's very painful on the downside.
I think Bob should let his feelings out, not keep it all bottled up inside.
That's why I wear long sleeves.
So my candidate for blame is complexity and the complexity of the system. And this is a little bit of a variation on the securitization that Brad talked about. Really, the financial system has gone in only one direction over the last 10 years, and that's been to create more and more complex products. There's been more and more layers of intermediation between the users of capital, like somebody buying a house, and the suppliers of capital, like investors or hedge funds or anyone with capital. So there were, I tend to think that at each step of the way, there were perfectly good reasons for these increased levels of intermediation. The general idea was to provide more choices as to how to choose your risk-reward trade-off. So you could take a little slice of the risk pie or the reward pie and fine-tune your exposure to that. So the general idea at each step of the way seems sort of reasonable, but the end result, the unintended effect of this, was to make the decision process much fuzzier. And the result of having a fuzzy decision process as to how to allocate capital was twofold. First of all, simply bad decisions got made, plain and simple. But secondly, and probably more insidiously, there was a general lack of clarity. People weren't sure about whether or not good decisions had been made or whether bad decisions had been made. And so the result of that was a freezing up of the credit system. So when it became apparent that bad decisions had been made, that caused a feedback loop where the fear that a particular security that was very complex, it was very difficult to understand, may or may not have a problem with it, then led that security to devalue. The fact that those securities were held by institutions that were providing credit then caused credit to be difficult, which caused the securities to devalue further. And you had a kind of a perfect storm. You had a perfect negative storm of feedback where these two things interacted. The bad decisions that were made caused more fear. The fear caused more bad decisions. And we're still in the middle of that. We're still in the middle of that bad feedback loop. And it hasn't been broken yet. So all of that was caused by the complexity of the system.
I'm going to avoid repeating what other people said. So this is no longer my number one reason, but I think it's a really important reason. And that is the proliferation of the 100% loan-to-value ratio and above mortgage. I'm a big fan of home ownership. I've written a lot of papers about home ownership, and in my business, getting cited is important. And my home ownership papers have gotten cited a lot. But the interesting thing is the papers I've written that sort of say home ownership is good have gotten a lot of citations. The ones that have pointed out that there are some downsides to it, like it constrains mobility, nobody ever cites them. Nobody ever pays any attention to them. We love home ownership in this country. The problem is when you have no equity in a house, you don't really own a house. Because by definition, if you don't have equity, you don't own something. So what do you have with a 0% down loan? What you have are basically two options. You have a put and a call. You have an ability to put the house back to the lender. Okay? So if things go badly, that's what you're going to do. And then basically you have a call option. If the value of the house goes up, you have an ability to refinance it with some equity, essentially, at the time that you refinance it. And so you basically call that loan. You buy that loan back from the lender, and then you get another one and buy the house with the profit that you've made. What's your cost of capital for doing something like this if you have to put nothing down? Pretty much zero. So your bet is either you have, if things go well, infinite IRR, or if things go badly, zero. Okay? Well, what's that going to do for the demand for housing? It's going to make it perverse, and it's going to drive prices up because people are not demanding houses for fundamental reasons. They're demanding houses because they're getting two free options, a free put and a free call option. And so we saw places like Modesto, California, see its house prices go up to a median of, I think, approaching $400,000. Now, somebody was saying to me the other day that God put San Francisco on earth so there'd be an expensive housing market. I don't think God put Modesto on earth so that there'd be an expensive housing market. You look at Florida, you look at Nevada, you look at Arizona, you look at the Inland Empire, you look at Bakersfield, et cetera. These are markets where 0% down subprime, 0% down loans made up more than 30% of the subprime loans in those markets. So I think the 0% down loan is not the leading culprit. I think some of the others hit on that with securitization in Raphael's points I thought were well taken, but a very important culprit.
I agree with all that has been said on my right, and I'll add the following very simple observation. We're in the mess that we're in today because too many people bought and guaranteed overvalued securities and overvalued real estate properties. And so the interesting question then is why did they do this? And there's a lot of reasons, some of which you've already heard, but a reason that we haven't dwelt on enough yet and that is not stressed enough yet in the wider debate that the country is now engaged in is the following. Too often the people valuing the securities, the people buying them, and in creating them, were paid now for creating risky positions, the value of which would be discovered in the future. And they often did this using other people's money. And so there were a lot of people who had an incentive to do deals because they were paid for doing deals that created liabilities and future risks that other people bore. And there are governance problems associated with the management of other people's money that ultimately are going to have to be addressed to ensure that we don't run into these problems in the future.
Okay, thank you very much. So now you have kind of an overview of how the panelists feel we got into this mess. We'd now like to turn to a few specific questions, and since we've, at the end here, focused a bit on housing policy and housing prices, I'd like to start with a question on that. And there's two related questions. One is, how long do you think it will take for home prices to stabilize? Will they go back to previous values? Which is really similar to another question that was asked, which is, what kind of risks are real estate buyers taking in today's market? So if we could address that, I don't know if Raphael, you might want to start as a housing expert, and then
I'm on the hook again, huh? You want to know how long?
I know you're way down on the end there, but I can still see you.
Housing prices are going to fall?
Yeah, please tell me.
How long do you think it will take for home prices to stabilize? And will they go back to their previous values? And then
So previous meaning?
Presumably
500.
05 values?
Back to the 05 values?
I'm thinking that the questioner is asking how, if they've fallen in value, how long will it take for them to stabilize and go back up to higher values? But the real question is about what kind of risk do you see real estate buyers taking?
Where the risk? I think a lot of the issue here has to do with the financing markets, and it gets to what was mentioned earlier about credit having to flow. If people cannot get credit, I mean, very few of us can buy a house cash, so we need these credit markets to function. If we can't get mortgages, then the demand for housing is going to take a hit. And as long as that happens, it's hard to imagine where the floor is going to be or how stabilization is going to happen. One of the things that's really interesting about this, we can call it an episode, is that it started off really as a non-economic event. This was a capital markets credit event. And what's happened in the last, 6 months or so, is that the real economy is starting to show some real cracks. That puts additional weakness in terms of demand for housing because if people were having a problem when they had a job, it's going to be much more difficult to imagine sustained demand when you don't have one, and so, or at least when there's a fear of losing it. So I'm not very optimistic at this point in terms of when stabilization will happen. I think Richard may cite some data to suggest that pricing is not so out of whack at this point, but it is there are real questions about the ability of people to get financing to be able to take advantage of the pricing relative to where people stand in terms of their general consumption of housing.
Richard, did you want to add something to that?
No, I think Raphael's got it right. The prices have come down so quickly in Southern California in particular that if you're going to live in a place for a long time and you're making a decision between owning and renting and you can get a conforming loan, which you can up to $729,000 through the end of the year in California, sort of what's called the jumbo conforming, the finances of owning make reasonable sense right now relative to the finances of renting if you know you're going to be able to keep your job for a long time, right? Because you don't trade houses every year. At least, well, we hope people have stopped doing that. They're not trading houses any years. So if you know you're going to live in a place for 5 to 10 years, and you're living in Southern California anyway, and many other markets around the country, I think Florida's still got a long way to go, and some other markets, then you're fine. But, most of us aren't lucky enough to be tenured professors. And I think people are very worried about their jobs right now with very good reason. And if you think there's a chance you're going to have to move in the next year or 2 or 3 to find a job in a different part of the country, then I think buying a house is a very risky bet at the moment. So it's all about your horizons at the moment. If you can have really long horizons, I think we're pretty much there in pricing. If you have shorter horizons than that, let's put it this way. If I were a new assistant professor and had no idea if I was going to have a job in 6 years, I'd be renting.
Yes. Fine.
I'd just like to add something. In order to stabilize prices, the issue has been raised about capital, the ability to get a loan. Well, I'm a purveyor and provider of capital to the capital markets. We buy mortgage-backed securities in my bond fund. I have a rule on our policy in our firm right now that we will not buy any mortgage security with an origination date after 2004. We will not buy any new mortgage originations, period. Why? I don't trust what's going on. There's been a fundamental breakdown. The government is interfering with the mortgage contract, the politics that have gotten involved. I don't know what my contract is going to be. Secondly, we're having this restructuring of the mortgage process through the servicers. And we've got to keep people in the home. I'm sorry, that interferes with the contract again. Now, there's a whole, you've heard about securitization here. Well, there's whole levels of securitization. And as you push out or keep people in a property at a reorganized level of just interest only or those types of things, you are now transferring value from the senior tranche holders to the subordinated tranche holders. Kind of like in a bankruptcy, you go into bankruptcy, but, we're going to pay the subordinated. How about even the preferred stockholders? Maybe even the stockholders. When this is an influx, we will not provide capital. So what we have here is an issue of trust. And we've had a breakdown in the trust in this system. And until that is reinstalled, then the capital flows will be disrupted. And I will not convey capital into this area. My obligation is not to the borrower. My obligation is to the people who have entrusted their assets to me to invest in a professional and prudent and fiduciary responsible manner. And that is not the environment we have today.
Any other comment on this question before we move on?
Yeah, a little bit. Obviously, there's going to be a mortgage market. Probably not for me, by the way. I have a house that's more than a jumbo would be, so it will be impossible for me to get a mortgage. Am I a good credit? Yeah, I'm a good credit. That's one of the problems that we have is that all day and all these strange type mortgages have gone away. So we'll have the standardized mortgage that will be done by Fannie and Freddie, and that'll be done, and the government will dominate the mortgage market, and that will keep some life in real estate. And now let's face it, the government is also going to be buying mortgages, right? Now, if they buy mortgages, they're going to bring some level of liquidity back into the mortgage market. I have a very good friend who's the head of risk management at one of the large surviving brokerage firms. And that gets it down to 2 brokerage firms, by the way, guys. And he forgot I was an equity analyst, and he said, Brad, I have no idea what the value of my residential mortgage-backed securities portfolio is. By the way, this does not reassure an equity analyst if you're talking about a brokerage. So he says, I have a pretty good idea what the top tranche is worth. I have a pretty good idea what the bottom tranche is worth, and I have no idea what the middles are worth. He said, I'm managing this to models because there's no liquidity in the marketplace. So he said, I think my models are as good as any other models. I have as many IIT, it's India Institute of Technology graduates, as anybody else. He said, but my hedges don't work. He said, my hedges don't work because my hedges are moving around up and down like this because they're still liquid. but these things are moving only with my models. He said, and I don't know whether the counterparties on my hedges are any good. He said, they have their own problems, and I don't know whether they'll pay me off when the hedges come up. And I don't know whether these assets will become liquid. He said, when we put these assets on, we didn't expect them to be on for 14 months. So I'm going to have to roll these hedges, and I don't know who's going to take the other side of them. That is a pretty good characterization of where we are in the marketplace right now, which is what the government's trying to do is to add liquidity to this asset side of the balance sheet, so the hedges move together. Now, all that means is we're going to, with some luck, get the mortgage market moving again, but it's not going to be the mortgage market that we've had in the last 5 years. It's going to be a government-driven mortgage market with, banks being enforced to take some level of mortgages, and a certain group of people who will be reluctant to take them until we see how this thing works out.
As long as we're appropriately compensated for our risk that we're taking.
I'm a little bit more optimistic, though still quite pessimistic. There is a price for just about everything, including the uncertainty that Bob spoke about. And the market will find a price eventually. Certainly with money being extremely cheap to banks, and with the opportunity to lend money to good credit risks as they present themselves, banks will start lending and they'll start creating mortgages. Those mortgages will have maybe 30-40% down, and they may only be to the very best risks, but transactions will take place because people move, there are life cycle issues, and the world will eventually move forward. The temptation to take advantage of huge interest rate spreads will generate transactions, and as those transactions take place, if people are careful, we'll see some comps that reflect values, or whatever values are created, and eventually things will start moving a little bit quicker. The way to move it quicker, though, is to try to eliminate the uncertainties that Bob spoke about. It's imperative that we have a better understanding of what's going to happen in the future, that uncertainty isn't generated by the government itself, and that the securities that are out there become well known, and who owns them and whether or not they're solvent, the owners. It's extremely important that we learn that information. And so to some extent, the government policies right now may alleviate some of those uncertainties by removing some of those securities from those people who presently have them and putting them to the government pockets and substituting higher quality securities that are easier to value. But there needs to be a whole lot more transparency than the government's presently proposed to seek.
Okay. Let's move on to a second. It's actually a second set of two questions that are related. And I'm going to read the longer version because it kind of gives the flavor of this, but it's really about whether the $700 billion fund will work. And one questioner writes, I work for a lender in a commercial real estate finance firm, and I agree banks are not lending, but I disagree that it is because, as Richard Green indicated, banks don't trust each other. It seems to me that banks are defensive, not wanting to lose any more money. Do you think the federal bailout will change that, and will it work? So let's address what will the federal bailout do? Who would like to begin?
I think Richard should go first.
Oh, thank you, Raphael.
You got called out in the question.
Why don't you go first, Richard, since you were
called out
mentioned
in the question.
So the motivation for why banks don't lend to one another, I'm happy to defer to the person who actually works at a bank. And if it's a defensive posture, then that's observationally equivalent to not trusting one another. And regardless, we clearly have a problem that banks aren't lending to each other, and we agree with that. The $700 billion bailout package, what can I say? When it was 2.5 pages long, I could tell you everything that was in it, which was almost nothing. Now that it's 504 pages long, I can't tell you much about what's in it except about arrowheads and other various tax breaks that have appeared in the newspapers. It's not very transparent, so it's hard to know whether it would work in light of the fact that I don't know that any of us really understand what's in it yet, and until it's implemented, I don't think any of us will. But I will make a couple of comments. Last week, my thinking on it is before it was approved was, on the one hand, I actually believe for once the Congress people were voting sincerely instead of politically, that the people on the left and the people on the right who voted against it because they had real fundamental philosophical problems with it as opposed to political posturing. And the people who voted for it were motivated because they thought it was better than nothing. Paul Romer today on the Growth Commission blog was talking about how the world is turning into fundamentalists and realists. And fundamentalists are people who want models to tell them what to do. And realists are people who realize that we don't have any models that are working right now, and so they have to try something. And so I reluctantly, at the end of last week, if somebody asked me would I have voted for the bill, I said if I'd been in Congress, I probably would have said yes. No, well, I would have, yes. That said, I think it goes about it kind of backwards, although there's an important provision in it that made it a lot better. The idea is that the Treasury is going to buy bad assets off the balance sheets of financial institutions. And the idea is, okay, the market isn't pricing these things right, or that it's not pricing them at all. And I buy that, okay? I'm not a University of Chicago guy. I believe that pricing can be wrong. Okay, when Merrill Lynch sold its mortgage-backed security portfolio for 22 cents on the dollar, I knew that those mortgage-backed securities certainly weren't worth par, but I had a pretty good idea that they were worth something more in an existential sense than 22 cents as well. Where in between those numbers you would have them, however, I have no idea. Okay, and the problem is basically somebody's going to have to model cash flows and pick a discount rate at the Treasury in order to come up with a number to offer for this stuff. And here's a place where I think even the best Wharton MBA, let alone the best Marshall MBA, is not going to be able to figure out what that right number is. So I have a real problem with how we're going to implement that. On the other hand, there's a provision in the bill that hasn't been remarked on that I think actually allows the Treasury to go about it in a much better way, which is it actually allows the Treasury to buy shares in financial institutions and to take preferred positions in financial institutions. And it seems to me one of the issues that financial institutions are facing right now is a lack of capital. And one of the problems we're having is delevering. They don't have enough capital, so they have to get rid of assets on their balance sheet, which causes the value of the assets to fall, which puts further stress on the capital, and you get this downward cycle. So I think if the government is going to intervene, having the government buy equity in a preferred position makes a lot more sense to me than having the government trying to price what securities should be. And the new bill allows for the government to do that. So it will be interesting to see whether the government does in fact do that. I think in principle that could work, but we also know that even when we think in principle what the government does is welfare improving, they can often screw it up anyway. So.
Yes.
And I can add a little color as to how the government's going to price this. Is they're going to hire asset managers to do it, like Western Asset Management. So they actually have RFPs out now. They're looking for proposals for private investment managers to manage the $700 billion, and there certainly isn't any shortage of takers who would like to get a piece of that. Bill Gross from PIMCO sort of offered to do it for free for public service or something like that, although as far as I know his company's proposal has a fee in it. So
he also had a subset to it that assuming he would do it for free if the pricing was priced at 65% of par or higher.
Okay.
Now, I wonder why that little feature was in there on it. I'm a little bit suspicious.
But yeah, well, I think that's called talking your book. But the question was, will the $700 billion program work? And it's very hard to tell, but it goes back to this question that I think all of us have talked about in one way or another, which is we have this kind of spiral where things are reinforcing themselves, where fear is causing asset prices to be lower, which is causing a feedback into the real economy, which is so you have a originally it started out as something that was confined to the financial services firms. And now it's bled over into the real economy. And then what's happening into the real economy is causing the value of the securities that are held by financial services firms to be lower, which is then feeding back. And so you have this terrible kind of cycle. So the idea was to break that cycle by taking a fairly large chunk of assets and stopping them from being part of that cycle of fear. The problem is that although $700 billion sounds like a large number, I think is it 10 trillion? I think is the size of the mortgage market. So this is kind of on the margin, maybe going to make some difference, but there just isn't enough to actually affect the entire market. So hopefully this will kind of break that cycle of fear and will reinvigorate the market. But it may be that this spiral has gotten way beyond just mortgages, way beyond the housing market, and just spread to a kind of virus across all credit markets, in which case it's going to be very hard to break it with just that $700 million.
Ken, when do you think that kind of effect might occur? It's certainly obvious. It doesn't appear to have occurred yet. So is there a time frame that you have in mind?
You mean breaking it, or
yeah?
Breaking the
cycle.
cycle.
The stock market's continuing to go down. This downward cycle still seems to be in operation. So is this something that if it were to work, would work in 6 months or a year or what?
I can't call it time frame.
There's an old joke in the fixed income market that is well worth remembering, which is what's the difference between a bond and a bond salesman? And the punchline is bonds mature. Now, the issue on this is that bonds mature. And so if you're a fixed income manager, like this one here, or that one over there, and you do nothing with your portfolio matures and rolls down the yield curve, and your duration shifts and gets shorter, and you end up with a big pile of cash sitting at the short end of the curve. And if you're scared, you're holding nothing but large amounts of Treasury, and the yields on Treasury keep getting lower and lower and lower. And if this cycle is like every other cycle that we've ever seen, what happens is at some point, some brave investment manager raises his head out of the foxhole and says, Exxon's not going away. I'm going to buy those Exxon bonds. And when he buys that Exxon bond, you start seeing a rally in the investment-grade corporates. And from that begins more courage in the fixed income market. Now, that's an easy thing for me to say. I'm an equity analyst, right? Now, the issue on it is that just as these gentlemen had pointed out, we're going into a downturn. So unlike previous ones where, the Fed raises rates and it causes a recession, right? And then we go through the cycle and comes back. Now what we've had is we've had a credit problem, which caused a decline in the value of credit-related products. And now we're going into a recession, right? And what happens in a recession, right? The likelihood that a high-yield bond is going to go down or a leveraged company goes down rises, right? The likelihood somebody isn't paying off their credit card goes up, right? The likelihood that someone's going to have to repossess that car goes up. So would you buy bonds in that kind of an environment? And, logically, that wouldn't be the time you take a large credit bet. So, unfortunately, this could be quite a while before it comes back. But I guess we should always get back to the joke, which is bonds mature. So the cash hasn't gone away, right? And so the cash will come back into the bond market, just won't come back right away.
I just want to add look at it is, I don't like to look at these things too technically because then I get confused. But if a doctor comes to treat you for an illness, they try to diagnose what is the issue. The problem is the Federal Reserve and the Treasury have not diagnosed what this problem is. They can look like they've diagnosed it. They come to the house. They have the black bag for those of us who are old enough to remember that. And they give your child a shot. And so the child gets a shot for the flu, but the problem is the child has the mumps. It all looks good, but it's totally ineffective. So the question I have in my mind when the question was posited about the $700 billion program, will it work? Well, shouldn't we be asking the question, what is the issue? Is the issue liquidity, or is it a issue of a lack of capital? If it's liquidity, then it's just about securities being moved around. If it's an issue about capital, then capital is the engine by which the whole credit structure reignites. At our firm, we do not believe the $700 billion program will work. We believe that it is the wrong diagnosis. It is everything that you read about this is about liquidity, about getting prices of securities to trade, etc. Or we'll manipulate the prices, or we'll eliminate short sales because we don't want to have financial stocks go down. We look at it as that there's been a fundamental capital destruction in the U.S. economy. It is called the debacle of the securitization. More than $5.50 of credit was created per dollar of credit in the U.S. financial system during the last 6 years outside of the banking system. So we're dealing with a credit collapse or a capital destruction. And the Fed is trying to move it back the other, and they keep talking in terms of liquidity. If they'd taken the $700 billion and they focused on that aspect about investing in companies and all like that, take a look at the model of Citicorp, what they were trying to do with Wachovia. They came out and they put out $42 billion. They say, we'll take the first $42 billion hit. The federal government would put in $12 billion. So that means Citicorp is net 30. They don't have to worry about the balance sheet because they punted that to the federal government. Then on top of that, they were going to borrow $10 billion in the public market. So their net in is $20 billion. Why would anybody put it in $10 billion? They would have to come out to you to buy that stock because they've contained or they've quantified the risk. Until the risk is quantified in the system, until we can calculate or do something like that, if they keep working around the edges and looking at the liquidity side, then capital is not going to re-enter the system until finally the prices get so low that over here we say, yes, at that price we'll go. That will take time. We view the $700 billion program. It could have been structured in a different way. It could have been done along the lines of what Citicorp was doing with Wachovia in conjunction with the FDIC and possibly the New York Fed. So that's my 2 bits.
Does anybody else have a comment on will it work?
Yeah, I'll just add one thing, which is we really don't know what they're going to do with this money. So the way that the statute is written, there's broad latitude that the Secretary of Treasury has. The Secretary could decide to use the $350 billion and buy shares.
I don't trust him.
No, I mean, I understand that.
For a guy that comes out and puts out a 2.5-page thing and says, I don't want to have any regulatory oversight, just give me the money and do that, and that's his posit out there, maybe it's a negotiating position, but I know I refer to him in my email back to my firm as Emperor Paulson.
Well, no, I'm not saying that was a good strategy. Right? So putting out a
it was no strategy.
2.5-page proposal. I actually think that Paulson was really nervous and scared that he saw the end of credit coming very quickly and felt like he needed to do something. Not being a politician, he just ran to the government or ran to the Congress and said, "We've got to do something. Here's $700. I think it'll cost something like $700 billion." I don't think it was much deeper than that. And I think he was a little surprised that others didn't see the crisis as critical as he did. But I do think that there's a lot that remains unknown. And the discussions that we've heard so far about transparency, we really don't have any transparency on this proposal, and it's troublesome. The only other thing I would add is that there is, I think that one of the philosophies behind this was if we can remove some of the bad assets, if we can remove some of the uncertainty that the institutions themselves have in terms of where their liabilities are, that might be enough. And the question is, and it's a question that all of us have to ask, who, especially you, Bob, since you've got all that cash sitting there, is how much else, how much more bad stuff do they have on their books that we just haven't seen yet? And that's part of the transparency that's not forthcoming so far. with Lehman Brothers, Bear Stearns, we've seen these sequential write-downs, and that's continuing, which doesn't really give us any additional confidence that they actually know what the value of their assets are. And as long as that continues, I think we're going to be hard-pressed to see your type of capital flow into this market.
But, Raphael, is part of what you're saying that because of lack of transparency and uncertainty about what the government's actually going to do, that actually plays into the kind of lack of trust and uncertainty in the market, so that policy approach may actually exacerbate?
No, I'm not saying that. There's enough uncertainty and fear in the marketplace. The government, if it's adding to it, I think it's incremental. I mean, I think that the fear is substantial enough that most people have decided to check out of the market anyway. What I'm saying, though, is that the likelihood that this would move us to action, some sort of transactional volume again, is hampered by the lack of transparency. And until we have that, I think it's less likely that we will see movement in the ways that the others have been talking about.
It's important to remember that there's a huge amount of cash right now floating around in both the U.S. economy and in the world economy. Much of that cash has been cycled through commodities, where we pay for oil and somebody in the Middle East receives that money and they've got to find some place to put it. An awful lot of that cash has been created recently through the central banks in the various countries as they're trying to address this problem. And there will be a point when people don't want to hold that much cash simply because they recognize that it's not doing them very much good, or they start to become afraid of the potential for inflation, and they're going to try to figure out how to deal with it. And at that point, they're going to all of a sudden become a lot more courageous and step in. Now, if that leads to a lot of inflation, that would be a disappointing outcome, but things will move forward. As we think about this financial crisis in the revaluation of real estate and so forth, it's easy to lose track of the following observation, that throughout all this time, the real estate properties largely have remained unchanged. The houses are there. They may be depreciating a little bit, perhaps because they're not being cared for by people who know that they're going to go through foreclosure. The machines in the factories and the patents and all the ideas that contribute to value in our economy are all out there. And all we're arguing about now is how those items are going to be valued and hopefully used. As long as people have some sense that they own these things and can control them, they will look out to maximize their value. And people are very, very creative. When faced with very significant financial challenges, they'll find ways of getting around them to ensure that the resources that they control have value. It may not be the outcome that we want. We may find that an awful lot of our housing stock ends up being rented, with a lot of people paying close attention to the renters to make sure that the housing stock doesn't depreciate, because renters frequently won't take nearly as much care as will an owner. And that may itself be expensive, but that housing's still going to end up being used, and ultimately those machines will be used, though perhaps not as much next year as this year because of the impending recession.
Good. Bob, you mentioned that you thought the monetary policy under the prior administration was partly fueling the kind of expectations that then led into this cycle. We have a question from the audience that focuses on what new regulations are necessary to prevent future financial crises, and maybe we ought to add something about what monetary policy. So this is a question about what policies in the future, what regulations in the future will help prevent future crises of this kind.
I love this. We only have the Treasury, the FDIC, OFEO, OTS, SEC, Federal Reserve. I'm sure I'm leaving out a few of them out there. All of those agencies had the authority to deal with this. They could have, the Federal Reserve could have changed the reserve requirements. the regulatory authorities at FDIC could have changed in the auditing process of the banks. It was already out there. Nobody wanted to do it. So now
they were ideologically challenged.
I don't care. I mean, I'm looking at, tell that to a person who's having their estate or their 401k destroyed right now that's going on. It's because, and so the solution is to give more regulatory authority to the people who didn't use the regulatory authority that they had in the first place. I keep going back to it. He says, this crisis that we're going through was totally observable and able to be planned for. Every time you have a credit inflation, it is followed by an asset deflation. Depending upon how you deal with it, you'll either have a shorter severe economic contraction and recovery and price discovery, or you obfuscate and delay and you get a Japanese solution. So we're watching to see what type of regulation comes out. I can tell you right now that while this was going on this year and the brokerage industry was allowed to have access to the Federal Reserve, and last time I checked, their leverage ratios were anywhere from 2 to 6 times what the banks were. I couldn't understand how they could borrow from the Fed and keep their leverage the same way. So it stood to reason that the brokerage industry would probably have lower profits going forward because they were going to be constrained. So maybe there's going to be regulation that way. But the regulation will only be helpful if you actually do it. And after every crisis, they diagnose the carcass, and you get unintended consequences, whether it is out of Faria, whether it's Sarbanes-Oxley, whether it goes back to the initial phases of the 1933 Act of the SEC, there are consequences. We're going to wait for it, and depending upon what happens, we will see how we will deploy capital. But right now, we think if you're a financial service company, you've got more regulation coming, including us on the investment management side. I'm not looking forward to it.
The best regulator...
I want to just pick up on the point about leverage. That's already been taken care of. The two remaining brokerage firms, Morgan Stanley and Goldman, have applied for supervision by as banks, which means that factor that you talk about, and this is an incredible thing that you couldn't have even imagined a month ago.
What couldn't you have imagined a month ago?
That they voluntarily asked for more regulation. Mm-hmm. That Morgan Stanley and Goldman Sachs have gone in and said, please regulate us more. Please take away our ability to leverage up as much as we did. And so that factor that you talked about is going away. And so in terms of increased regulation, incredibly, the people who were remaining, the only ones who were left, who were in some sense unregulated in terms of what their leverage could be, have run to the regulators and have said, please regulate us so that we can't do this again.
Brad, I think you had a comment as well.
Yeah, actually, for those of you who are graduate students and you're looking for that PhD thesis subject, one of the really fun ones is the impact of the SEC's regulatory rules on the brokerage industry in 2004. They rolled out some regulatory rules called Basel II. Basel II was written for and designed for commercial banks. Well, what do commercial banks have? They have lenders of last resort. They have deposit bases, right? And so Basel II opened up the ability of brokerage firms to take leverage to the moon, to add illiquidity to their balance sheets. I got a senior woman at a major rating agency drunk one night, and I asked her, I'm an equity analyst, right?
An asset play.
I asked her, why didn't you stop them? And she said, the brokerage firms came in and showed us that they had better Basel II ratios than the banks did. And how could we stop them? Basel II had been approved by every central bank in the world. So, the subject of the report is unintended consequences of a regulatory regime applied to an industry that it wasn't designed for, right? Good PhD thesis. Now, let's think about what's going to happen. Morgan Stanley and Goldman are now going to be commercial banks. We're not talking about becoming Wachovia. We're talking about these guys becoming Bankers Trust and JPM, which for those of us who have gray hair or dye their hair like I do, Bankers Trust and JP. I didn't get her drunk, right? Bankers Trust and JPM were brokerage firms disguised as banks. In other words, they had a lender of last resort. They had somewhat higher ratings than the brokers did. They didn't do as well in trading because their leverage ratios were low. They had an intrusive regulator. You could characterize the Federal Reserve as a very intrusive regulator, but a reasonable regulator. You can characterize the SEC as a non-intrusive regulator who's unreasonable. So this is going to be a change to these guys. What's it going to do? It's going to cause Morgan Stanley to get rid of its oil tanker fleet. It's going to cause Goldman Sachs to get rid of its power plants. It's going to cause Goldman Sachs to shrink its private equity business. It's going to cause Morgan Stanley to get rid of its natural gas gathering systems. These don't fit on a bank's balance sheet. Now, the other thing that's going to happen is, so what will you have? You will have brokerage firms that will be tamed. So think of them as wild horses that now are going to be broken. And that means that there's going to be a place in the marketplace for to take on the mantle of the Lehmans, the Salomon Brothers, the Bear Stearns, and the Kidder Peabodys, the gunslinging traders. And who will be those? Those will be the giant hedge funds who will go public. They will they will have permanent equity. They will raise debt, and they will not be they will not be regulated. And then you're going to have a bunch of small boutiques who are going to be the next generation of investment banks. So Greenhill and Lazard and any number of small boutiques are going to pop up. Why? Because the investment bankers have learned that they don't want to tie their compensation to a trading firm that can blow up, right? Now let's think of some other regulatory issues that are going to happen. One, the SEC is going to change the disclosures required in securitizations. They have total authority to do that. And once they do that, they've increased something called underwriter's liability. If you're an underwriter, if you're an investment bank and you underwrite a bond and that bond and the company that you underwrite goes bankrupt within 3 years, you are contingently on the risk. You will be sued for a violation of something called Section 11. You didn't disclose the risk. Section 10B that says you didn't do good due diligence. And the SEC can increase that underwriter's liability by making more attestations that have to be made about in the underwritings of securitized products. That improves quality control. I think these are very logical things.
I was going to ask you anything on the side of the buyer of the securitizations.
Well, you have underwriter's liability. I mean, Frank, you can go after them for that.
No. I'm going to say is because there was a movement to include the firms that buy the securitizations, because by us buying the securitizations, that allowed the underwriters to underwrite it, get their greed out there, and allowed the individual to have a purchase of a car or a house. So there was there was positing along this way that the investors in the securitizations could also be brought into this for some type of risk, and we saw that, and I said, "Boy, that's really a good idea. That's really gonna make me warm and fuzzy to open up my coin purse and let the moths fly out." I said, "Snowball in hell."
Richard,
yeah, you're right. That would increase costs.
Richard, do you want to add something to this?
The comment about Basel II, and actually the comment about sort of representations and warranties made me think about something I was very, very wrong about. I worked at Freddie Mac for a short period of time, and one of the things I worked on there
was at Lehman.
Was your work. Was capital allocation. And our rule said that for mortgages we guaranteed, we only had to hold 45 basis points of capital. And for loans that we owned, we had to hold 2.5% capital. Okay. So these are leverage ratios of either 40 to 1 or 200 to 1, roughly, were permissible. And when I was at Freddie, I was looking at the models and looking at the performance of these loans and blah, 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 and I thought, this is reasonable. Right? If you look at the standard deviation of loan performance of these things, the probability that you would eat through this capital, if you make certain distributional assumptions about when shocks happen, was remote. I mean, I'm telling you about, this was back in 2002, 2003. This is before the Alt-A stuff started being bought and large. These were prime mortgages. There should have been no problem based on the history of the books of mortgages that the company had done. The problem is, as the guys in 1998 discovered, is sometimes you get way outside of history. And when that happens, model-based capital rules have real problems. Okay, Basel II, again, was a model-based capital rules. And these are really incredibly smart guys developing these. I'm using guys, by the way, in a sex-free sense. Men and women developed these models. They had PhDs in economics and finance, and statistics and physics from the best universities in the country. They were serious people. They came up with very good models. And the problem with all econometric models is the parameters change with history. And so the lesson of this, to me, is there is got to be a point where you say, no matter what, if you're a company of a certain size, if you're a financial institution of a certain size, you have to have X% capital to be considered sufficiently well capitalized. Now, I don't know what the number is. I sure know it's more than 45 basis points on a guarantee business now. And the thing about capital is it's a regulation that it's hard not to enforce it. I mean, if the law says that, if the regulation says you have to have, let's just say, 6% capital is minimally acceptable capital, so leverage ratio of like 16 to 1. Okay, it's hard to fake that. You can actually do some window dressing. But basically, that is a really hard thing to fake. That's hard to attack politically if it's actually in place. Just one quick more point about capital and regulation. But the other thing is, when you have this sort of chain of investors and chain of originators, I think one of the other things we learned is every one of them has to hold some capital. Because no representation is any good if the person holding the bag, when they try to get to the next person in the chain who originated the bad security, has no capital behind their representation.
Larry, why don't you be the last person to speak to this policy position?
We all have. The very best regulator of foolish behavior is a deep appreciation of the risks associated with it. People do not like to lose money, and they will pay very close attention if they feel that there's risk that they're going to lose money. In a world where people fully appreciate the risks that they're exposed to, they won't take the risks that they can't live with. And in that kind of world, you don't need capital requirements. You don't need an SEC that is telling people what to do or a Federal Reserve that's telling people what to do. The problem is we don't live in that kind of world, though we can try to bring ourselves as close as possible to it. So some of the ways that we can bring ourselves closer to it is to have more transparency so people recognize the risks that they're facing. But there's still another problem, which is that there are a lot of people who will bear risk without recognizing it because they simply can't understand it, often because they're represented by other people. This is the other people's money problem. And it gets compounded by the fact that the people representing them often are paid for short-term performance and not for the consequences, the long-term consequences of decisions that they make. And those are the reasons why we often need to have capital requirements as a substitute for the knowledge that would prevent people from doing foolish things. We simply say, okay, somebody wiser than you is going to decide that you can't do something that we think is foolish. That's a very troubling thing for people who believe in free markets. But it's very clear that a lot of people can't solve these problems for themselves because they don't have the information, if they were capable, or because they simply aren't capable, because we're all specialists in our own areas, and frankly, because many of us simply aren't well enough endowed to be able to process all of this, or that we would want to spend all this time. And as a consequence, we do have regulation, and the regulations have been developed over many years of experience that reflected these standard problems that appear over and over and over again. And the problems are that you give people an asymmetric return distribution. So you tell them we're going to pay you if this happens, but not if that happens. If that happens, you walk away and give the problem to somebody else. Then it's not surprising that people take those kind of risks. So you have a regulatory mechanism that was set up to deal with this, and frankly, in the last 8 years, it was largely ignored. The systems were in place, but if you were in those agencies, I was in the SEC, and you spoke to these types of problems, agency problems, externalities, and so forth, what happened was you were told that you can't talk about that now because we believe in free markets. And while I believe in competition very, very strongly, it's essential that the competition proceed in ways that address the problems that we've just discussed, agency problems, externality problems, where people do things that affect other people, but they're not penalized for it if it's a bad thing, and they're not rewarded for it if it's a good thing, and information problems in general. So we're hopefully go back to more sensible regulation, but hopefully not over-regulate, because you over-regulate and then you just kill the creativity of the economy.
Good. That's a really good, I think, general statement around regulation and the policy issue involved. There are 2 or 3 more questions.
Excuse me, I'm sorry. This is just a quick one. There's and I apologize for interrupting on this one, but okay. There's a misperception about how Wall Street compensation works, which is well worth at least understanding. It takes 9 years to become a partner. During which time you have no personal life, and you can't keep relationships alive, much less a plant, and then you get to be a partner.
Sounds
right?
like being an assistant professor.
Well, here you go. But you get to be a partner. Now, this is the odd thing. The average lifespan of a partner is about 5 years. So it's like being an NFL lineman. Your knees go, right? And so you make a lot of money during that 5 years, but you don't get to make a lot of money forever. Now, the companies recognize that. And so what they do is they take roughly 30 to 40% of your compensation and they put it into company stock. And that company stock is put into something called a rabbi trust. And a rabbi trust owns the stock, holds the stock for you, and then at the end of a 5-year period opens up and drops the stock into your account. You can't hedge that stock. You can't short that stock. You can't do anything against that stock. So the idea was to keep the partners rich but illiquid, right? So that they had money in the game so that they could avoid exactly the issues that are being talked about, that they would have something in the game and they want to take long-term decisions. So I guess what I'd like to point out, because there is a misperception, yes, Wall Street people are amazingly overpaid, and I will admit that, myself, I have never believed that I'm worth what I'm paid. However,
I do. I want to say I do.
Okay. However, I guess what I also would say is the comment that the Wall Street people are walking away being rich. That is exactly not true. The Bear Stearns people have been wiped out. The Lehman people have been wiped out. And the Morgan Stanley partners and Goldman partners who are still there are certainly not happy about the situation that they're in.
I'm not prepared to say that they're overpaid. There's a market for labor, and the labor market responds. I think that they've been mispaid, and a good example of this is the experience at AIG. So you had a group in AIG that was writing credit default swaps that turned out to be extraordinarily damaging to the company. They were paid 35% of the premia that they were writing in the year that they were writing it. And Brad has said that maybe they had to take 30 or 35% of that and put it away. But the fact that they were getting paid for doing deals that apparently the senior management of AIG didn't recognize is very problematic, because they were imposing huge liabilities upon that firm that must not have been appreciated, because had they been appreciated, surely the senior management wouldn't have accepted it. So there was a governance problem within that firm, but the problem was is that they were getting a lot of money out, and if they lost that 30 or 35% that came from being, of course, that an insurance company, not a investment bank. But this type of compensation you see all over, and it's not just it's not so much in the banks. The banks have addressed it. So the hedge funds get paid 2% for managing and 20% for their gains. But if they lose, they just eventually lose the opportunity to manage the money. That is a formula for maximizing your volatility, because if you maximize the volatility and it works out, you make a lot of money. And if it doesn't work out, you walk away and find something else to do with your life. A lot of people were attracted to that, and a lot of money is lost through that compensation scheme.
I actually just want to jump in on this regulation issue as well, because this is not just a Wall Street issue. All through the chain, from home buyer to mortgage broker to lender, the incentives were not in place for any of them really to do sufficient due diligence. They all had significant upside gain and very limited downside exposure. So when you want to think about regulations in this context, the states actually have a significant role to play here, because the states are the ones that regulate mortgage brokers and all of those. And the amount of attention that we're seeing across the states on these issues, there's tremendous variation there. Some states are doing a lot about it, some states are talking a lot about it, and then some states aren't doing anything. So if we're going to think about the overall structure, we have to think about the incentives and the exposures that are faced by everyone in the chain, because it starts at a very local level. All of this is about individual properties and individual transactions that then get aggregated up to a Wall Street level. But if you have problems at the beginning, you're certainly going to have problems on the backside. So you need to have that regulatory structure put in place as well. I
think I have to add something here. We're all talking about regulation, as if regulation's the end-all, be-all going out there. I'm a head of a company. I manage bonds and stocks. I don't depend on any regulator to regulate my judgment about whether I should invest in a security or not. I thought that's what I was getting paid for. And so the problem is that we exercised extreme due diligence, patience. We also withdrew from the market. We put Fannie Mae and Freddie Mac on our restricted list 2.5 years ago for no lending to them. We put AIG on the restricted list 18 months ago. We put GE on the restricted list 6 months ago. Not one regulator, not one credit rating agency or anything else. It was us going through the process of doing our due diligence. Why? Because I guess we have some investment integrity and ethics in this whole process. And it's not about other people's money. We call it our people's money. I have to look at my family and others out there. It's not a corporation. My company used to be part of a corporate entity, and we had some of the biggest boondoggles in the mutual fund industry because they didn't have any skin in the game. That is not the case. And so we sit around our table asking, say, what can go wrong? And we're not thinking about Washington regulating and doing that. No one has ever come to us about those things. And so I look at the industry, why we're in this mess. It's not because of just regulation. It's because the whole investment field didn't do their job. The regulatory agencies didn't do their job. And it was people thinking about a one-off time of getting paid. There is a firm out there that did take, shall we say, the responsibility and try to protect. I think he's called God, called Warren Buffett. In 2003 said, derivatives and credit default swaps are weapons of mass destruction, financial destruction. Yet people went out there. We looked at whether we do counterparty risk. We couldn't get comfortable with the counterparties, so we wouldn't do it. Yet we have a whole industry, brokerage firms who got involved with this. Where is the responsibility of going through and managing this? As long as you have people who will not take responsibility, you're going to absolve responsibility, then you're going to get what Larry says down there is a dysfunctional system. and regulation will not cure it.
It would be irresponsible not to talk a little bit about the governance problems that were associated with Freddie Mac and Fannie Mae. These two public corporations were created by government charter, and they were stuffed, the directors were stuffed by government processes, and they were heavily influenced by 535 congressmen and senators and an administration that wanted to make sure that the housing industry did well. And as a consequence, they simply didn't exercise the discipline that they should have exercised in choosing what mortgages to buy and what mortgages to insure. Had they exercised more discipline, we probably wouldn't be in this problem. And they are the big gorillas, and they forced other participants in the industry to basically follow them. But had they exercised that discipline, they would have gotten a lot of static and a lot of noise from the government that wanted to see housing expand and continue to expand, and in part to ensure that the incumbents would be reelected in 2004. At the SEC, we try to regulate them, or bring them under our regulatory umbrella, which is simply disclosure, get them to disclose their accounts on the same basis that all other public companies disclose their accounts. They were exempt from public disclosure because of their special charters. They finally, after a ton of negotiation, agreed to voluntarily disclose, and even then they had such huge accounting problems that we never got a clear story, and basically we still don't know what the clear story is. So some of the problem has to be laid straight to the government and to all the processes that we're seeking to, in the name of the public good, maximize the housing stock, or simply distribute money to builders, or keep brokers happy, or whatever. And the trouble is that these companies assumed enormous liabilities under the claim that the government wouldn't be liable, but in fact we found out that the government decided that they were indeed going to be liable after all. And of course that was expected because they were able to borrow money at such cheap rates. That's the evidence that people expected this to happen. And so the problem was that they were dealing with other people's money, but in this case the other people's money was the government's money, which I needn't remind you is your money.
I think Richard wants to make a comment on this, and then I would like to move on to the next question.
Just briefly, I don't want to defend Fannie or Freddie management because a lot of what they did is not defensible. But that said, in terms of leading into the crisis, if you look at Fannie Freddie's market share of the mortgage business from 2002 to 2005, it dropped pretty precipitously. And filling in that market share were asset-backed securities. And if you look at sort of the history of when Fannie and Freddie started to lose their discipline, it happened as they were following the subprime lenders. So in terms of it, this is not to absolve them of culpability in all kinds of ways, but still, I will say when I was there in 2002, 2003, I thought the credit underwriting models were really well-done models. Now, again, we now know that even well-done models can have problems. These were very serious people, and there was a very conservative risk culture at Freddie when I was there. Richard Arent, who was the CEO, became CEO the week that I left the company, fired the guy who was the chief risk officer of the company maybe 18 months after I left. And it was actually the moment where I said, what are those guys doing? Because this guy, and what they were doing is they were losing all their market share, and so they felt, I think, enormous pressure to start allowing their underwriting standards to deteriorate. That said, I don't think they ever got quite as bad as some of the things we saw at WAMU and Wachovia and some of the other good names. But
as the dean of the School of Policy Planning and Development, I'm really pleased to hear that everybody wants to keep talking about policy and governance. And so I find myself in the odd position of trying to cut that discussion off, which is in some odd way what our school does mostly. There's a couple of questions that I still think it's worthwhile for us to get to before we kind of wrap this up. One is deals with foreign investment in foreign banks, and it's this. How can we be assured that foreigners will continue to buy our debt and will step up to buy the $700 billion of the rescue package? So this question is around the role of foreigners in this crisis.
I'll take it. Despite all of the craziness you've seen, the number one export product of the United States is financial security. And there are a lot of people in the rest of the world who are not financially secure because their governments are thinking about how to steal their money, or because other people are thinking about how to steal it or tax it or otherwise expropriate it. And so you got a lot of people through the rest of the world trying to figure out how to get their money under the United States legal umbrella. So we may have some serious troubles with the financial system, but the legal system remains very sound, and in particular, well, moderately sound. In particular, it's generally possible to write a contract in the United States and have it enforced in a predictable way. But as Bob said, if you have the government revising contracts, we're going to lose that. And if we lose that notion of legal security, then we're going to lose the value of the United States as a provider of financial security. Part of the craziness that we saw in the last few years was also a reflection of the commodity boom. And there's reasons for that, but let me go through that interesting story. The commodity boom put a lot of money into the hands of people who were living in insecure places. And they looked and they said, we've got a lot of money, and we don't trust to leave it here in Iran or Indonesia or places like this. And so we need to put that money someplace else. If your fear is that you're going to lose the money by hanging on to it where it's at, you're willing to accept a negative expected return if you could just get it someplace where you think it's more secure. And so what does the world look like when there's a lot of people whose required rate of return is actually negative? They end up bidding up assets without a whole lot of judgment. And so I don't say that it was the fault of the foreigners who created this problem, but it's certain this issue certainly didn't make things any easier.
Yeah, I just say that in all of the most panicked moments over the last couple of months, it was quite clear that there was the flight to safety where money, whether it was U.S. money or foreign money, went into U.S. Treasuries. And at some point, the flow into U.S. Treasuries, the panic flow into U.S. Treasuries was so great that the yield on them was zero or even slightly negative at some point. So I think to Larry's point, the U.S. is still seen as the safe haven. U.S. Treasuries, I think if the U.S. was no longer the safe haven, you would see this flow into Japanese government bonds, and it did a little bit, or some other place. But in fact, U.S. Treasuries continue to be, the haven of choice. Then after you make that decision of sort of domicile, then the question is, do you want to take on some credit risk? And I don't think there's any evidence that U.S. credit risk is any worse than any place else. In fact, it may actually be better, and you do have the rule of law here. So I don't see foreign money deserting us at this point.
I would only add is that I'm undecided on this. I'm watching to see what happens over the course of the next year or so. Next year, the Treasury is going to have to finance at least another $1.5 to $2 trillion in treasuries that they would not have otherwise because of what's going on in this credit crisis. So there's going to be a huge amount of need to have this financed by the international area. If the international area believes that we are going to maintain the security integrity of our dollar and its purchasing power, then we will be able to finance. On the other hand, if we do not, then we will be paying a progressively higher rate of interest to attract capital, just like any other borrower that degrades its balance sheet. So to me, the issue about will the foreigners continue to buy our debt or insure to buy our debt is still an open question, dependent upon what and how this crisis is financed. If the If the money supply is grown and lets to expand, then I think that's going to make people fearful about the long-term purchasing power. So it's still, in my mind, they'll continue to buy our Treasury debt and do that sort of thing, but this latest currency depreciation of the dollar, when the dollar went to 162 on the euro out there, it raised a few flags in the international area, and the Fannie Mae Freddie Mac crisis raised some issues, so that right at around that point in time, the foreign purchases of U.S. Treasury securities were declining. In fact, they dropped by about 50% on a couple of the auctions, so it raised some issues there. So I'm kind of watching to see how this will play out over the next 1 or 2 years.
Actually, they're already abandoning us. If you go to the International Monetary Fund site, they actually have a database of the reserves by currency, by country. And if you look at a time series of that, it's actually kind of interesting if any of you get off on game theory, which is, if all of us are long dollars, right, it is in all of our best interests to keep the dollar strong, right? On the other hand, it's in each one of us' best interest to cheat on that by slowly diversifying out of dollars, right? And that's exactly what you're seeing across every central bank in the world, is that they're all building euro reserves, but they're not building them rapidly because they don't want that run on the dollar because they're all long dollars. So for those of you who are in the investment club, I will tell you I have a substantial portion of my money in euros, and that's because there's only one other alternative, right? There's the euro and there's the dollar, and those are one of them is going to be the reserve currency.
Okay. All right. We had one more question from the audience, but it's getting pretty late, so I think I'm going to turn at this point to one final question for each of the panelists to answer. We started this out by looking at what caused us to get into this mess, and I'd like each panelist to just take no more than a minute to focus on one thing they would like to see us do to get out of this mess. So I'm going to start at the other end again with Raphael and move towards me. What
did I do? Did I miss a meeting today or something?
To have the last word on what should we do.
If I had to point to two things, I think actually Bob was on to something when he talked about capital and finding ways to free up capital and get it flowing again. So I'll let him talk to that. I think that one thing that really needs to happen is that we need to address issues of confidence and trust in the system because our system is based on that. And if we don't have that trust, then at an institutional level or at a household level, the way that we do business and the way that we transact could stop. And that, to me, is that's the elephant in the room that we're trying to not talk about, but that we're facing. So I think we need to take some steps to build trust. I think that the bailout, whether it works or not, was a signal that at least people were paying attention and were going to try some things. I think that's an important psychological stage. I don't think 2 weeks ago I was talking about I was hoping that there would be more bully pulpiting of some of the lenders, actually having the Secretary of the Treasury, the President, the Chairman of the New York Fed, the Chairman of the Fed, getting folks that have cash and that are potential lenders and saying, look, we need you to stay in the game. We need you to continue to participate, and we'll have your back. Now, I was hoping they'd do this quietly so that it didn't create, a whole host of public issues about who's doing policy and all that sort of stuff. But it's the equivalent, really, of saying we're not going to let you become decapitalized. We're not going to watch you go out of business. We're all in this together, and we need to take our steps and you need to have faith in us, and we will have faith in you. So that, I think we can still have those sorts of conversations. I think that doing it in the public arena is counterproductive because it introduces a whole host of other considerations. But I'm very hopeful that that those sorts of conversations are going to go on and continue to go on until we get this broader stability so capital can flow.
Brad?
To tell you the truth, I'm not exactly certain how you solve a problem of confidence. I've been through problems of confidence in the past. Crash of '87, Morgan Stanley lost 20% of its funding in 2 hours. I was running the funding desk. Japanese didn't speak English anymore. The Italians wouldn't answer their phones. What you're seeing right now is the total breakdown in confidence. Nobody knows who has the Lehman risk. The derivatives market is based on a series of agreements called netting agreements that net risk across companies. They're not enforceable anymore. So they've found out that therefore no one knows who's got the risk, so therefore everybody's dealing with each other very, very carefully. People are worried about Morgan Stanley and Goldman, and they're dealing with them carefully. The Fed today had to step in and save the commercial paper market. What does that mean? That means that they're worried about people like Caterpillar and Deere that finance themselves with commercial paper. They're worried about companies like Discover, which finance themselves with commercial paper. It's not a good sign. This is a sign of a lack of confidence in terms of everything. I think the comment that we just had, which says, striding onto the floor of the New York Stock Exchange and saying, "I'm going to buy," like J.P. Morgan did in the famous story of him doing that at the turn of the century. It's exactly what you need. You need people to step up and just start buying. This flies right in the face of fiduciary obligations over here, right? But that's exactly what is necessary. Think of it from yourself, because this is really always the best way to do it. Because remember, there's nothing magical about the people on Wall Street or the portfolio managers. They are just like everyone else. I mean, you have money in your bank account. Are you comfortable going out and investing right now? Yeah. Having that money in the bank account feels really good, and of course, that's what's happening everywhere.
I'll go back to the basic, the issue of how to get ourselves out of this mess. I think of one thing: allow failure. As long as you socialize risk in the system, you will not correct this mess. You have to allow risk to re-enter the system. As long as you try to have a free market on the upside and socialize risk on the downside, it is a non-sustainable model. So therefore, in order to get capital coming back into the marketplace and redo this, the Federal Reserve and the Treasury have to shift their sights from a liquidity model to a capital model. That means co-investment along the way so that you pick winners and losers. Well, if you're not going to pick winners and losers, then you're into the Japanese model. So what gives me confidence that they're going down this road? They just raised the FDIC insurance premiums insurance from $100,000 to $250,000. Is that allowing the system to work? No, it's allowing bank depositories that have been ineffective and haven't minded their business to still be able to borrow in the marketplace and keep themselves solvent. That is not clearing the market. That is not allowing the system to work. So as a result, as long as I see the Federal Reserve and the Treasury fiddling with the thermometer of the U.S. economic system, the system will be in trouble. When they came in 2 weeks ago and eliminated shorting, they were playing with the model of the U.S. economic system. Shorting was not the problem. And oh, by the way, you had a 16% rally in 1 day in the financial service stocks. That's market manipulation. Today, the market is lower than on the day that they came out and allowed shorting to occur. So what did the federal government do? accomplish on that? Nothing. But what did they do accomplish in my mind? They told me that they're going to continue to manipulate the thermometer of the economic system, and as long as they're doing that, this financial mess is going to continue. So I need confidence, and I've got to have confidence in contract. I have to have confidence that the balance sheets that I'm working with are solid, but today I have no confidence in that. So if they want to instill confidence, the government's better going to have to write out a check and co-invest with us, take some of the upside risk, and then we'll gradually creep out of this mess. I think it's going to probably be not a month or 2 months, but if they go down the road of allowing failures and restructuring the system, then probably over a period of a minimum of 2 years and probably as much as 4 years, we might be able to do this. If we don't go down this policy, then I see a very long-term period of time of substandard economic growth, and the profit margins in the United States will be under attack very severely. This is not a happy thing. That's why I'm sitting on 45% cash in my funds. I've talked about this for more than 3 years. In my bond portfolio, I'm sitting on a 1-year duration and have been for 6 years because I don't trust what I see going on in Washington. Hope that makes everybody happy and cuddly.
I said, when I talked at the beginning about what's wrong, and I said what's wrong is complexity, and I think the answer is, don't do that. Don't engage in the kind of complexity that got us here in the first place. So, for example, I'm sure that Bob would loan me money if he knew about my balance sheet and looked over what I was doing.
Yes, and so did somebody mentioned J.P. Morgan. In the 1907 crash, what he did, he's got the major banks into one room, and everybody had to open their ledgers, and they sat down and said which bank was going to survive and which bank wasn't. And during a very short period of time, he consolidated the crisis and got it done. That was not about obfuscation. So, yeah, if you open your balance sheet to me, and I have integrity, confidence in your assets and all, and I look at your cash flows and all, sure, I'm going to make a loan. We're doing that right now with some banks. If they'll originate loans with various requirements, but then we keep getting back to how the government can interrupt the contractual relationship. So
I think you just promised to give me a loan, which is, thank you.
At a usurious rate.
But the point is that with clarity, with transparency, with simplicity, the capital can start to flow again. What's happening right now is, users of capital, people who need to use capital, and the people who have capital are not getting together. And the way to get them together is to eliminate a lot of the complexity that has removed the confidence, removed the faith from the system, and to have just a more direct route from the providers of capital to the users of capital. And the system is very clever. I mean, our financial system is very clever at working this out. Right now, that mechanism is broken, but I think it's going to work out a simpler way over time to get the capital to where it needs to go.
I guess I want to start. I have to respond to a few of Bob's comments. I mean, the government has been touching the thermostat on the economy in all kinds of ways for a very long time. We have the fact that we have a Federal Reserve at all means that we have decided government sets the federal funds rate, for example. That's a pretty important parameter for the economy. And I know there are a few people who think the Fed is unconstitutional and want to get rid of it, but I still prefer a model where we have a strong central bank to one without. Similarly, FDIC has been around since, I think, 1934. I may be off a year or two on that. And I think it's done a pretty good job of keeping us from having bank runs on a regular basis. I think it cures certain externalities that happen from financial contagion. And I think the last time the FDIC limit was raised was 1979. I think that's when it hit 100,000. GDP in the U.S. at that time was a little over $2 trillion. We now have about a $13 trillion economy. So relative to that, increasing it by 2.5 times may not be such an unreasonable thing, particularly for things like transactions accounts where businesses have to know that their payroll is safe between the time that they put the money in the bank and it gets paid to employees. I do, however, agree that I do think that the injection of capital should be the emphasis in terms of trying to get out of this. And Paul Krugman
who, regardless of what you think of him as a newspaper columnist, he's a very fine economist who's done really wonderful academic work. And he has a paper on his Princeton website that he just put up there a day or two ago where he looks at models to try to explain what's going on. And he's the one who really convinced me, using a very nice, simple, formal economic model, that this really is more of a capital crisis than a liquidity crisis. So, Bob, I don't know what you think of Paul Krugman agreeing with you, whether that ruins your day or not. But
I never let facts get in the way of my own opinion.
But capital, and I think about the key about this, capital, in all kinds of dimensions. And the one good piece of news we've had in the last couple of weeks is Warren Buffett actually stepping up to the plate and buying stuff. And I have said Warren Buffett has been wrong in my professional career, and of course every time I've done that I've regretted it, so I'm going to stop doing that.
He's got more money than almost God.
Yes, exactly. But a final point, though, is I don't want, the idea that securitization is in and of itself a bad thing. It's something that's floating around out there, and I don't think that's right. I think using securitization in order to connect capital markets to mortgage borrowers has on net been a socially good thing. And I think when properly done, it's a good alternative model, not a substitute, but a good alternative model for a bank model, because it does allow for things like geographic diversification. It's very beneficial both to investors and ultimately because it creates liquidity to mortgage borrowers. So let's not say all of the innovations that we've seen developed over the last, really going back to the 1970s, so 38 years, have been bad things. They've been abused, but it doesn't mean we want to get rid of them. And similarly with derivatives.
It's clear that people are very afraid, and as a consequence of that fear, they're not willing to lend, and that's going to gum up the financial system in an extreme way. The way to deal with fear is to remove uncertainty. So transparency is extremely, extremely important. Now, following the Bear Stearns blow-up, there was a proposal to deal with this type of uncertainty, to increase more transparency, that never got anywhere, although there was a lot of, they're working on it, but they just didn't work fast enough. And that proposal was to turn to what might be called a private credit management agency, but we don't know them by that term. They're known as clearinghouses. A clearinghouse is an entity that guarantees performance on contracts. So we typically see them in futures markets, where the buyer of a futures contract and the seller of a futures contract put the clearinghouse between them. And the clearinghouse guarantees that the buyer will perform, and the clearinghouse guarantees that the seller will perform. And then the buyer and seller don't really care about each other. They just care that the clearinghouse works. And the clearinghouse spends a lot of time paying attention to the buyer and seller to make sure that they will perform. Now, the neat thing about this arrangement is if one buyer enters into a contract with another seller, and that seller, say the buyer then decides to sell to some other buyer. So you have the original buyer buying from one seller and then taking his position and selling it to somebody else. The original trader no longer has a position. He's longs to one side and short to the other side, but they offset each other. In a clearinghouse, the clearinghouse would recognize that and say, you're no longer liable to me because you've offset your position. But without a clearinghouse, the buyer is in a liability position, a risk position with the seller on one hand, and acting as seller is in a similar position with the buyer on the other hand. And then all three parties are concerned about the creditworthiness of everybody else, and nobody knows where the offsets are because there's not enough transparency. It's absolutely essential that we solve this problem very quickly, that clearinghouses be established for far more contracts than we presently have. There's been a lot of standardization of contracts, which is essential to use the clearinghouse model. where the clearinghouse model has not yet been implemented. And even where contracts vary, it's essential that those contracts be standardized to some extent so that these risk positions can be offset so that we have some sense of where people are. And then finally, I would say this simply the notion that everybody open their books now and show where they're at would help us tremendously. We don't allow people to, we don't force people to open their books generally because we don't want to reveal their proprietary trading strategies. That seems to me a secondary or even a tertiary condition or concern at a time like this when we have so much risk and vulnerability in the system. It's time for everybody to show what they're at so that people can figure out who's solvent, who's not, and those who aren't solvent, they should be closed very quickly. And to that end, it would be useful to have a streamlined bankruptcy process where the equity is simply wiped out overnight and the the subordinated debt, the debentures, the stuff that's not mortgage bonds and so forth, they instantly become the new equity. That will delever the system without taking out the capital. It's still important to bring in capital, but the capital is out there. It's just not utilized. There is a ton of money out there. Once they're confident to reinvest in the markets, things will take off again.
Can I just make one add here before we close? If any of you out there would like to visit our website, we've been writing on this for quite some time. It's not a marketing website. It's more of an educational website. You can go to www.fpafunds.com and look under latest news. And you will find many things written there on the credit crisis. And you can also go to my shareholder letters, which are under shareholder letters for FPA Capital Fund and FPA New Income Fund. And I would urge you to read my associate's letter for FPA Crescent Fund. Out there, they're all educational. Both his fund and my fund have been closed for several years. He just reopened, so we don't have a marketing bias here. So, and you can also read about my worst investment failure on the website, which will give you some background as to what led to this crisis because it involved securitization back in 2001. So everything's there.
I'd like to do one other plug, though, as long as Bob is doing a plug. We're going to have to do a plug for USC. If you like what you heard and you're still looking for a school, USC is the right place to go.
Thank you all for coming. Thank you very much. And thanks to the panelists again for a wonderful panel. Thank you.
Good one, Larry.